Welcome back. You're watching Crystal Ball. I've been in conversation with Madhu Kela of Reliance Capital. Let me ask you about contrarian investing now, because the focus, as you rightly said, has been so much on quality that there are sectors in the market which are quite unloved. People just don't want to go there. Most of what we like to call high beta, whether it's real estate, whether it's commodities, whether large parts of power. Of these three sectors which do not belong to the favored sectors in the market, which one would you plump for?
I would say, Udayan, as a whole basket, I will evaluate the full thing again on a bottom-up basis. So, if you remember last time also when we interacted, we divided these companies into two parts. One are the companies where the balance sheet has gone to an extent which doesn't look that it can be repaired. So, we are, regardless of what the valuations are, we don't want to touch them. But within this sector, there will be some companies, like what happened in technology, if you remember, in 98 to 2000, there were 400 technology companies which got listed. But 10 years down the line, there is still 10, 15 good technology companies which have survived, and 380 of them have vanished. So I am emphasizing a similar situation in this entire, you can club them as either rate-sensitive sectors. So there will be few winners in these sectors, and we are extremely focused on actually identifying those winners. So we are looking at operating leverage. Right now the operating leverage may come because of the fall in commodity prices. The operating leverage may come because of the fall in interest rate. The operating leverage may come because sales will rise much faster than what the market is emphasizing. And I am convinced that in this entire bucket, whether you talk of tourism, hotels, whether you talk of real estate, whether you talk of even construction companies, there will be few winners over the next 3 to 5 years. And one has to really focus. And this is where I think some kind of a disproportionate money will be made in these stocks, in these names.
What about public sector banks? Would you buy them now?
I would say, again, it will be very selective, Udayan, but maybe I would love to watch public sector banks for another 2 quarters before we really pinpoint that this is a big bank buy. And again, we are very clear that it is not a whole sector which will be bought. There will be maybe 1 or 2 or 3 banks which you would like to identify and hold on. Because clearly, if the whole story of India has to play out from a medium-term perspective, there will be few winners from this space, but I would still watch them for a quarter or 2.
Where do you see the maximum risk of valuation compression in the next 6 months?
As we discussed, Udayan, there are individual companies which have run beyond their near-term justification of even 3-year earning growth rate. So they belong to all the so-called hype sectors. And my learning again, Udayan, that I am no one to say that 50 PE multiple is expensive or 70 PE multiple is expensive. In the technology boom, we have seen that the last leg of euphoria in the market can take these companies to even 100 PE multiple or 150 PE multiple. We just have to be conscious that they do not form a disproportionately large portion of your portfolio, and that is what we are focused on. So every time a company which is expensive becomes more expensive, our approach is to trim down a little bit and make sure that as a basket they still are forming a reasonable portion of our portfolio and not an unreasonable portfolio, not an unreasonable portion of our portfolio.
You spoke about domestic flows, Madhu. Do you get the sense in your interactions that people are finally convinced that they need to be in this asset class after the experience of the last 1 year, and they have matured enough to buy some dips in the market? They won't get rattled or thrown by it?
Yeah, there is no doubt in my mind, Udayan. I think people are convinced that they need to participate in equities. When I interact with a lot of our IFAs, independent financial advisors across the bank section, there is a lot of interest in equity. The problem is that, people have put out of 100 if they wanted to put, maybe they have put 10 or 20 rupees, and they have been waiting for a sizable dip to come in the market. And what is confusing them is the ground reality, because when they talk to people like us, they hear a story of India, what is going to happen in the next 3 to 5 years. I'm talking 6-9 months back. And when they go and talk to a industrialist who's there on the ground, he tells them that nothing is happening on the ground, but the stock prices are are telling a very contrarian story. So they are in a dilemma as to whom to believe. Do I believe a person who has experience in the market, or do I believe someone who is doing a real business? And that is what has caused them to not to participate. But I am sure, as I said, maybe in the next 2 quarters, the earning growth starts to improve a little bit, and market gives them a chance, whether it is in time-wise or price-wise. But my mind, Udayan, is there is a huge amount of money which is waiting from the domestic markets to come into equities. And as I explained, the other parallel asset classes, whether it is real estate, whether it is fixed income, whether it is gold, whether it is any other asset class, to my mind, can't still compare the equity returns if you have a 3 to 5 year perspective. Let me, as a matter of caution, let me say that equities can't be viewed with a 6 month or a 1 year return perspective. But if anyone has 3 to 5 year perspective, he will still make superior return in equity as compared with any other asset class.
Gold has been a bit of a dog, Madhu. Do you have a view on gold yourself, and do you sense general disenchantment with that asset class amongst retail or domestic investors?
Yeah, I had a clear view then. I think we spoke many times in your channel at different interactions. I think as an asset class, it has done whatever it had to do. Gold prices went up 10 times, and it went up in an era wherein there was a concern whether some of the biggest nations in the world will fall, and that is what was supporting gold to be an international currency. I think till the time that fear comes in, I don't anticipate that fear to come in, but if at all that fear comes in, then only you are going to have a chance in gold to make money. Otherwise, I think for a real long period, we may have seen the top in gold.
Let me talk about a sector which you are fairly close to, insurance. What's your sense of how big returns can be from listed insurance plays because of the recent changes? Do you think it's an area of big opportunity, or do you sense that the market has discounted quite a bit of it in the price already?
No, I don't think the markets have discounted, because this is one sector which has not done well in the last 3-5 years. Insurance companies have seen negative growth rate, have seen a very muted growth rate, and I think in a way it has consolidated, that we don't see a lot of new entrants which we used to see between 2002 and 2006 come in this sector. And you see there whatever regulatory changes which are being talked about, including what we recently heard in the press, the opening up of the bank insurance channel will bode extremely positive for this sector. And if independent companies are getting listed with a proper track record and at reasonable valuation, I think this is one sector where there will still be a lot of money will be made. Again, I would repeat, at the cost of repeating, that this is one sector which has not seen a lot of growth within. So I don't expect insurance companies, whenever they come and do the offering, to do the offering at astonishing valuation. So there will be downside protected from a medium-term growth perspective, and there will be opportunity to make money here.
Madhu, always a pleasure. Thank you very much for taking time out today.
Yeah. Thanks, Udayan. Thank you very much.